From Barangaroo Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB. I'm Juliette Sarli. This Thursday afternoon, look, we had a terrible day on the market yesterday. Not really what you would call a dead cat bounce today, but at least a little bit of green on the screen. Let's have a look at where the CBO 200 is finishing out the day's trade. It was up by about 1/3 of 1% last I looked, and there we see it again. The ASX 200 also rallying into the close, up 24 points or 1/3 of 1%, 7,974. The banks all looking good. The tech stocks looking good. I'll get to that in a moment. Where you did see some weakness was the likes of Woodside. It was hit with not only a broker downgrade by Citi, but also it traded ex-dividend today. All right, let's get into the themes of the day and a little bit of a tech bounce. We know that we had that tech wreck across Asia yesterday. Today you are seeing a rebound coming through from the likes of WiseTech, which of course is one of the market darlings. Also Xero up by 2%. And the interesting one is NextDC, which has received what you call a speeding ticket from the ASX, because at one point its shares were up 12%. The ASX saying, hold on, what's happening here? Why is your share price moving so much on no market news? NextDC saying that it is not aware of why its shares have rallied so much, although it was added to a US A-REIT index overnight. I think it was called NAREIT index. And also the other factor around NextDC is just this interest in some of these data centers after the move that we are seeing with AirTrunk as well. Now we've got the RBA's recession warning. Governor Michelle Bullock spoke today in Sydney. She's actually going to be speaking again tonight at the Women in Banking and Finance Awards, but she certainly gave a warning in the sense that yes, she knows that a lot of households are struggling. She even indicated that perhaps 5% of Aussies might have to sell their homes due to higher interest rates. But she said the flip side is that if they cut rates, inflationary pressures are going to continue, and that will hurt the economy and Australians on a deeper level and potentially push us into a recession. So she also indicated they will not hesitate to hike if they feel that they need to. So certainly she is not taking any shtick from anyone suggesting that the RBA is making a policy misstep and needs to start cutting rates. And digging deeper, we're seeing this iron ore bear market deepening. Iron ore, the contract, dipping below $90 a tonne. This is the lowest since November 2022. When you look at the futures contract in Singapore, which is down another 2% today. Now, iron ore has slumped by more than 1/3 this year. It's down 10% this week alone. And this is all about the China property crisis wreaking havoc on the steel industry and, of course, these battery loss-making mills. Let's have a look at the sectors of the day. We're starting with energy, okay? Thought we'd look at the miners, but let's start with energy in terms of what we saw with the Woodside impact. If that's going to come up, nope, not working. Have we got any of them here? Otherwise, we'll move along to our guest. Yeah, let's just get into our guest today and get his thoughts on what has happened in the market. Nathan Somasundaram from Deep Data Analytics joins me. Thanks for saving me from tech failing on us. I mean, not quite the rebound that we would have hoped for today. What's really caught your eye? Because there is a lot of concern about the resource sector.
Yeah, there's a lot of movements. I mean, overall, the markets are relatively, I mean, I guess if you day-to-day volatility, if you ignore that, the markets are relatively flat, but there's a lot of things moving in random moves all over the place. So, I mean, the iron ore fall, I don't think it's going to surprise a lot of people. Most people knew, but they didn't want to accept it. Then it happens every time. I mean, I remember in 2014, 15, everyone knew the capex cycle was going to end. Everyone knew iron ore was going to fall, but everyone was shocked when it happened. And we're doing that again. So we have this tendency to get shocked by the obvious things. So I think the slowdown in China has been happening for a while. We've had 2 years of stimulus stories, but no actual stimulus. And the property market remains weak. And steel prices, there's a lot of tariffs coming to block Chinese dumping steel overseas, so that the demand for steel is weak. Steel ETF is rolling over. So I don't see any short-term catalyst to turn it around. It would be naive of us to think that China basically deflated their property bubble for 3 years and we're going to suddenly turn around and put stimulus to pump it up again. It just doesn't make sense in the short term. So I think the cycle is playing out like it should. We got excited, now we're coming back. But the interesting part is there's a lot of other things moving. I mean, like AirTrunk with data centers, and we're seeing what's happening in the energy space. So there's a fair things moving around. Like you're seeing some commodities basically pricing in recession already, like what we're seeing in the energy space.
Yeah.
While other commodities are still doing relatively well.
All right, I want to come back to the AirTrunk story in a moment because NextDC was fascinating. But just to your point about this commodity cycle unwinding, does that mean that some of the stocks like Mineral Resources, like Fortescue, look like a buy, or do you stay away from them?
I think you need to see a catalyst. I mean, both of them are great exposures. When the cycle is working for you, it's not working for you right now. So I don't see you need to have to pick the bottom. FMG, you always knew it's a single commodity play. It's a lower quality play. When the cycle turns, it's always going to come back hard. Min Resources, you got two main commodity play. Both of them are struggling. So I don't think you need to pick the bottom, but it's definitely, for me, Min Resources is definitely interesting. But I'm not jumping in. I'm just waiting for the catalyst for it to turn around. I don't think we've seen the bottom. I think it goes a lot lower. It could actually, if you look at it over the last 3-4 years before the pandemic bounce with all commodities, you could see it going back to $20 or even mid-20s. So there's a fair way down. So one thing I have learned in years in the market, you see a stock fall 30-40%, you go, maybe it's the bottom, and then you see it fall another 30-40%. So you wait for the catalyst, and I don't see the catalyst yet.
All right, let's talk about NextDC. The ASX going, hang on, what's happening here? But it could just all be about this data center thematic, given what we saw with AirTrunk.
Yeah, look, another big player in the data center space is Infratel, and that's up as well. So the market is basically looking at their M&A play and looking at these sectors and saying, look, these guys are good, they're doing stuff. I mean, I don't think NextDC is cheap, but when you're looking at it on an M&A type approach, you don't need to be cheap. So people are jumping into sectors where there's M&A interest, and this plays into a number of other thematics like AI and everything you can think of. Tech runs into data centers, so it makes sense. But I think that thematic has been fairly well priced. Someone trying to buy a NextDC now will be paying way too much. I don't see someone jumping in there. Infratel is a very good diversified asset play. The majority of their asset play, it's in different assets, but the data centers, especially the government data centers that they run, are pretty good business models. So it's one that gets forgotten, but again, it's a data center play. So I think the thematic that's being played about is because of that M&A. Suddenly everyone's looking at it going, well, who else is potential candidate?
Mathan, what happened with Challenger Financial? Why was it in the news today?
Yeah, we got a big block on the market, major shareholder getting out. It's actually quite an interesting model. It's one of those unique business models. You need a PhD to understand the risk management in that one. I think it's, I've seen enough actuaries lose hair on that one. But it is a unique model. It's an annuity model, which is quite, I suppose it's part of a long-term investment strategy, and it can work in an aging environment. So there will be demand for it, and because it's such a unique play, the customer base will come back, and we've seen I suppose fixed income underperform for a while, and that should turn around, and I think Challenger will do relatively well. So it's interesting that the shareholders getting out now. I think probably looking at somewhere else at the moment, but for unique business model, hard to understand. Challenger is a pretty good one, and the pullback after this has actually made it quite interesting. I mean, the last update was actually pretty positive. So Challenger is one to look at.
All right, and in these times, Mathan, where we don't know where to hide, is it just the sense of going to those gold players?
Yeah, I mean, the spot gold in US dollars is pretty close to all-time high. In Aussie dollar terms, 3,700. Most miners have dramatically underperformed. They always do. And the market doesn't believe in gold miners till the cash flow comes in, and then suddenly everyone chases. So I suspect at this point, pretty much even the worst operators are churning out cash. So the good guys, the big guys are doing quite well. The smaller guys are probably taking a few hits on operational level. I suspect everyone will forgive everything when cash is coming in. And in a tough market where, RBA chief just basically told you, it's going to be tough. And it's going to remain tough for a while because the other option is even worse. So in that environment, I think gold still looks good. And the only answer for all central banks is to print more money and add more debt. So in that scenario, gold continues to look good. And I suspect that's going to flow into gold miners, over time, and the market will chase it.
Yeah, fascinating what Michelle Bullock said, because as you say, the alternative, or as she said as well, could be a lot worse. All right, Mathan, thank you so much. As always, Mathan Somasundaram from Deep Data Analytics. The stock of the day, one that remains in a trading hold, it was Star Entertainment. Grady Wolf from Bell Direct joined Howard Coleman from Team Invest.
It's probably an avoid for me because there's just ESG issues that really conflict with what my personal morals and values are. As Howard I know will probably say, you want to put money into companies that give you money back and don't make you spend a lot of your money. So I think with the Star Entertainment Group, you want to see returns. They haven't made returns. The 5-year chart's even worse. It's 88% down over the last 5 years in shares. So if you're a shareholder, there's better places to put your money. So for me, definitely an avoid.
As an investor, you'd probably do better finding a casino and putting your money on black or on red on the roulette wheel, because you've got almost a 50% chance of making a profit and more than a 50% chance of making a loss. Yeah. I think that would sure beat putting money into the Star Entertainment Group at this stage.
All right, taking a look at the leaders on a day when we did see a little bit of a gain coming back into the market. NextDC, I was just talking about that with Mathan. Look, it said to the ASX it's not sure why its shares are rising so much, but we're talking about the interest in data centres after the AirTrunk news. Red 5, Charter Hall, Ordinate and Ramelius also looking good. To the downside today, Coronado Global Resources, we were just talking about that block trade as well with Challenger down 11.5%. Woodside Energy, ex-div and a broker downgrade. Strike Energy and Mineral Resources under pressure as well. All right, what is happening tonight? The US Challenger job cuts, also that AD. Oh, I forgot the small caps. What happened in the small end of town? Okay, I should do it though. Let's do it. Okay, sorry. This is what happens when I'm left by myself. US A2P private payrolls, the US ISM Services Index, and US unemployment claims all coming through tonight. I got very excited and got ahead of myself. Tomorrow, what are we looking for? Not much. Lending indicators for July. I think there's still a couple of stocks trading ex-dividend. I am just going to ask for a moment's reprieve while I try and find those, because of course they do weigh on the market, as we saw with the likes of Fortescue earlier this week, and also Woodside today. Tomorrow you've got Aussie Broadband, WiseTech ex-dividend as well, so that could actually hurt the tech sector, because as we know, WiseTech has had a rebound today. It's paying out a 9.2 cent dividend, 100% franked. All right, looking at where the market is as we round out the day's trade. We're up by about 1/3 on the CBO 200. The ASX 200 is up 1/3, 7,973. A rebound in some of those tech players, including NextDC we've touched on, and WiseTech, which is up 1.3%. The big miners looking good, the banks looking good. And worth noting, I think CBA is back towards those records, $141.08. Up by 0.8%. Look, it keeps rising no matter what brokers say. All right, that does it for today's edition of the COB. Be sure to join us from 9:45 a.m. Eastern tomorrow morning. We'll see you then.